If you're looking for discounted deep value stocks, I've got 5 you'll want to consider right now. So in alphabetical order, I've got iRobot, Pfizer, Sirius XM, Walgreens, and Zoom Video Communications. So all these stocks have taken a pounding recently, and they're trading at levels they haven't been in at least 5 years or longer. In some cases, far longer than that. So these stocks come with varying levels of risk, and I'm going to rate them from riskiest to least risky. I don't have any positions in these stocks, so I don't care whether they go up or down. So the riskiest stock I'm going to say is iRobot. So iRobot shares plummeted this year after the company's deal with Amazon fell through. So basically, regulators in Europe didn't want to go through with the deal, and so Amazon ended up walking away, and that's what you see, this big drop, this big cliff here that happened in the early part of 2024. And so as you can see, the dashed line, iRobot hasn't been this low since 2009. We're talking a 15-year low. So this is a really beaten down stock, and it's just hasn't been happening recently. It's been for multiple years. You can see since about 2021, it's been nosediving down. So what's been the issue? Let's look at their financials. So you can see revenue over the years has been declining. So that's one problem. Another problem is they're not profitable. And if we flip over to cash flow, they're also burning through cash. So operating cash is their day-to-day operating activities. This is not even capital spend, anything like that. This is just to keep the lights on. They're burning through their day-to-day cash flow. So that's a big problem because the risk of dilution is really high. And what that means is as the company has to issue more shares, that's going to dilute existing shareholders and drive the stock price down. It's already been going down, so it doesn't need any help with that. So the only way I could see iRobot shares rallying at this point is if somebody else comes in to buy the stock at around 200 million in market cap. It's not an expensive one, but as you can see, it also isn't a terribly great business to be in. You know, iRobot makes the Roombas that automatically go around and clean your house, but they also cost several hundreds of dollars depending on the model that you have. So it's not an expense that a lot of people are rushing out to buy right now with inflation high and people looking to cut back on expenses. So iRobot is definitely the riskiest stock of the bunch here, just because without Amazon, without an acquirer, it's going to be really hard to see this stock rallying and improving from these lows that it's at now. Second riskiest stock is Walgreens. So Walgreens is a company that's in transition right now. They're for years their margins have been horrible. They got a boost from COVID vaccinations and all that traffic that brought into their stores. But this is a company that earlier this year they had a new CEO come aboard October of last year, Tim Wentworth, and one of the first things he did in January was slash their dividend basically in half, and that's big news for Walgreens because before this year, their dividend streak was 48 consecutive years. So they're on the cusp of 50 straight years of increases if they kept it going, and they could have, but Tim Wentworth saw that this was a company in trouble and wasted no time to slash that dividend. So I mean that's a good thing in terms of freeing up cash flow and for the future of the company. For dividend investors, that's a bit of a blow just because that's a bit of a loss. So if we look at Walgreens chart, this stock, I mean, it is at such a low, you have to go back to, before the 2000s, the previous millennium, the last time the stock was trading at such a low price. So as you can see here, we're going back all the way to the late 90s, the last time the stock was this low. So I mean, this is a mammoth beating. This is one of the most beaten down stocks you can find right now on the markets. That's how bad of a beating it's been taking. And so if we switch over to their financials, you'll start to see that this is not really a surprise given that the company they don't generate a whole lot of growth. Pretty fairly constant. I mean, they're stable, but their operating income, has been negative. Slim margins. I mean, you're talking, 970 million in operating income on 132.7 billion in revenue in August 2022. I mean, small margins can work if you're an Amazon, if you're a Walmart. Walgreens isn't that big, or at least not compared to them. And so these small margins don't work. and that's a big problem. So the company's been transitioning to healthcare, so they're launching hundreds of clinics at their stores. The idea is they're going to go bigger on primary care, give people more of a reason to go to their stores and obviously do shopping at the same time. So sort of being an all-in-one shop. So Tim Wentworth's hoping that personal touch and the connection that the company has with its customers and being in prime locations near a lot of U.S. neighborhoods is going to work to its advantage. But the problem is this is a company that's also not in terribly good shape. Their cash flow. They've been looking at selling assets just because they're not generating a whole lot of cash, and they're going to be spending a whole lot to invest in their healthcare strategy. So they're not generating a whole lot in operating cash flow. As far as their balance sheet goes, if we look at their cash, has dropped down sharply over the past year. So again, they're not in a great cash position. This is definitely one of the riskier stocks because I don't know how much longer their dividend, even though they slashed it, I don't know how much longer that's going to last. So Walgreens is definitely the second riskiest stock of this bunch. For them to turn things around, I mean, the new CEO is going to have to show that the company's on the right track and they're making improvements towards profitability, but that could be a long-term play before that happens. Middle of the pack is Sirius XM. So Sirius XM has also been falling and is trading at multi-year lows. So here we've got Sirius. You see they're trading around 2013 levels. So again, way more than even a 10-year low here. So they've been doing really poorly. They also offer a dividend, but the problem again go back to the financials. The company hasn't been generating any growth. Their sales are actually down last year, so that's a bit of a problem. The good news is they are profitable though. They are turning a profit. If you look at their cash flow statement, they're generating operating cash flow positive. It's a really good sign and easily close to $2 billion. So not a bad business. I think once travel picks up and people are doing more road trips using Sirius XM satellite radio more often, I think it could be there could be a path for the company to recover and the stock to rally. If you look at their statistics, so we've got their financial ratios. Only 10 times earnings, even 10 times estimated future earnings. The PEG ratio 1.1. So normally if the PEG ratio is 1 or less, that's a good buy because that factors in the 5-year outlook for the stock and for the company. And so analysts see a lot of growth for Sirius in terms of the bottom line. So this is not as bad, not nearly as risky as Walgreens or iRobot. The big risk is really whether they can stimulate their growth, their top line. This is a Buffett stock, so Warren Buffett, Berkshire Hathaway holds Sirius XM stock. I mean, that doesn't really mean that the company is going to be a good buy. There's some bad options in Berkshire's portfolio as well. Sirius isn't one of the better ones, but I think it's middle of the pack in terms of there's a possibility for this stock to turn things around. It's not as dangerous as the other ones. It's profitable, generating operating cash flow, so it's not too bad. But next up, the second safest stock on the list, I'm going to say, is Zoom Video Communications. So Zoom has been taken. Zoom is obviously your classic COVID pandemic stock. It rose in 2020 and then crashed when things came back to normal. And so right now at $59, they're right around actually all-time lows technically. So if you go back to 2019 when they first started trading, that's around the levels that are at now. So right around 5-year lows, all-time lows. So the stock has been struggling because obviously this is a company that benefited a lot from stay-at-home, remote work, people calling in to do video chats through meetings. But in terms of its financials, it's actually not in that bad shape. Revenue has been progressing, has been increasing slightly. They're not in horrible shape. They're a profitable business now. It's also important in terms of their operating cash flow. Again, just like Sirius, they're generating a good positive operating cash, so not too bad from that sense. if you look at their earnings multiples, 29 times trailing earnings, about 12 times forward earnings. The PEG ratio is a lot higher, but I think Zoom is a bit of an underrated play in this sense, just because as someone who's used Microsoft Teams and used alternatives, I can tell you Zoom software is phenomenal. It's easy to use, much better than the alternatives. I think the company does have a bit of a better future than what investors might be showing with the stock price. So I think it's a bit of an underrated play, just because the company's still good. It has good fundamentals. It's figured out how to be profitable, and even with all the competition, I mean, there's been so many of those video conferencing apps that have come out over the past years, and you know what, Zoom is still probably the most popular one out there. So I mean, that says something. So it's established a bit of a strong brand. I think there's more potential for this stock as it expands its products and diversifies a bit. So I don't think this is as bad as the stock price suggests. This one's a pretty underrated buy, I think. So as far as the safest stock goes, I'm going with Pfizer. So Pfizer, again, another COVID stock that has been plummeting of late. But if you look back, the stock is trading at around 2012 levels. So again, a 10 plus year low. It's significantly discounted, and there's not really a big problem in terms of Pfizer's financials. You'll see a loss in one of its most recent quarters, and that's because they had to do some write-downs due to due to its COVID products. But overall, the company is profitable. It's generally a fairly stable business. As you can see, 2023 was a really bad year for the company in terms of operating income, 3.3 billion versus 37 the previous year. So it did benefit hugely from those COVID vaccine sales in 2022, 2021. But 2023 was also a bad year because of the write-downs. Overall, obviously, it looks concerning when revenue drops from 100 million to 58, or from 100 billion to 58 billion. And this year, they're expected to be flat. So not a whole lot of growth in the near term. But last year, Pfizer acquired Seagen, a cancer company. So they're expecting that Seagen is going to bring 10 billion annual revenue by the end of the decade. Pfizer is also investing in its pipeline, and so it's expecting to generate, I think, around 25 billion in new revenue by the end of the decade. The problem is, obviously, they're losing that big bump from COVID. They also have some drugs that are losing exclusivity in the next in the coming years, so that's going to be a bit of a risk. But realistically, that's a risk anytime you're dealing with the healthcare industry, just because patents don't last forever. And Pfizer's been around for ages. I mean, this is a company that knows how to innovate, knows how to come up with new products and all that. So right now, I think investors are being overly punitive with the company. This is still a solid business. If you look at their earnings multiple, trailing PE, again, looks really high because they're coming off a bad, I think, fourth quarters when they did the write-downs. But if you look at their forward PE, just 11.6, and their PEG incredibly cheap, 0.25. So I mean, based on the growth that analysts see in not just the year but the next 5 years, this is an incredibly cheap stock, 1.6 times book value. So a real value buy for sure. And another reason you may want to be tempted to buy Pfizer stock, 6.5% dividend yield. That's abnormally high for the stock, and a big part of the reason is because shares have fallen so far down that yield's gone up as a result of that. So Pfizer is a bit of a long-term play, just because it can take a while for the drugs that it's working on to start generating significant revenue. But I think as that happens over time, that the bullishness is going to come back, and there's going to be a lot more potential for the stock to rally in the long term. This isn't a stock I'd expect to quickly turn around in a few weeks or a few months, maybe not even in a few years. But if you're in it for the long term, if you're willing to hang on, I think there's a lot to like about the stock right now. It's low valuation, it's dividend. It's a bit of an underrated buy. People are really being a bit overly punitive, I think, because of the COVID effect, and thinking that this is just a COVID stock. But realistically, there's a lot more potential for Pfizer. So again, I don't have any position in the stock. I don't care which direction it goes, but I think in terms of value, there's a lot of value here for people who are willing to hang on, because if we look at Pfizer stock, I mean, this is really at a really reduced price compared to where it's been at in the past. So potentially steal of a deal here if you're in it for the long term. So if you're looking for deep value buys, I'd say Pfizer is one of the better ones, followed by Zoom. Sirius is a bit of middle of the road. Walgreens is a bit risky. I mean, it could have a lot of upside if things go well, but it's a bit risky. iRobot is probably the riskiest. You're basically betting on a buyout at this point. But those are 5 stocks that you may want to consider. Really cheap valuations compared to where they've been at in the past. So good luck and happy investing.